I think the broad range of experience that I've personally had has very much helped. So I spent my first 15 years of my career as a bond trader. And when you're a bond trader, you really get to see the weeds of the market. You get to understand how markets work, what drives them. I then spent about 2 or 3 years at one of the major banks on their balance sheet, helping to manage a risk, followed by 10 years for the New South Wales government, managing their funding and the balance sheet. So I've had a very broad range of experience, both across markets, but also across government. And so as a person who looks after government bonds, it gives me a great insight into, firstly, the economy, which of course drives interest rates. But secondly, it also gives me deep insight into how the securities within the government bond market function and how they work and how they perform. The key principle when you're managing bond portfolios is coming up with the framework where you think the economy is. Are interest rates likely to go up or are they likely to come down? Is inflation going higher? Is it going lower? So that's the first question you've got to ask, and you've got to have that framework in place. Once you have that framework in place, you want to make sure you're moving with the trend in the markets and the economy. But within that, you need flexibility. And this comes down to market pricing and experience. For example, if you believe interest rates are going to come off, that's good, and that is the prevailing trend, but you've also got to ask, are markets over-optimistic about that? Perhaps they have 8 rate cuts in when you think there's only going to be 4. So that's where the flexibility within the framework comes in. That's very important for an active bond manager, because getting the framework right is where you can make a lot of performance, but adding value within that is all about active management, and it's about the flexibility within that framework. As everyone knows, government bonds are a defensive asset class. And what do we mean by defensive? What we mean is that they are slightly lower yielding than other fixed income instruments that you can buy. And why would anyone buy an instrument which yields lower? Well, first of all, they're very highly rated, so the credit risk is lower. The second reason though, which I think people generally underappreciate, is they are the highest level of liquidity. When you have a diversified portfolio, the 2 most liquid instruments you can have in there are cash and government bonds. And why is that? It's because the whole liquidity system that the Reserve Bank operates in the economy and the banking system is designed around cash and government bonds. So when you hold those 2 instruments, you have absolute liquidity, even in times of high market stress. Now that's important because it's in times of high market stress, perhaps, that you do want to allocate back to equities because they just collapsed and they're offering a lot of value. You don't want to be trapped in assets that you can't sell, like term deposits, or perhaps some less liquid fixed income instruments with lower credit ratings. So government bonds perform 2 roles. They are defensiveness and diversification for a portfolio, particularly as investors enter the retirement phase and they put a higher priority on that. But secondly, it's the liquidity aspect. The Government Bond Fund is very much at the safe end of fixed income. As you can imagine, very highly rated securities, but secondly, very liquid securities. And by liquid, I mean you can raise cash by selling them through all market conditions. Not many investments can do that. And we had an example of that, of course, during COVID. So really the people who buy government bonds tend to put a high priority on liquidity. Now, there are 2 major segments for that. One is insurance companies, who obviously need to be liquid. And secondly, banks themselves need to make sure they've got liquidity. And so they tend to be some of the larger buyer of government bonds. So the clients who tend to invest in government bonds are looking for diversification. They're looking for liquidity. And really what it is, it's almost like, you're buying insurance for your portfolio. And like all insurance, through a lot of market conditions, you don't need to use it, but it does become very helpful at certain points. One of the great things about running a government bond portfolio is the number of levers you have to add value in an active management. So first of all, there's clearly calling the economy and interest rates correct. So the portfolios we have, we will take them longer duration than the benchmark, or perhaps shorter if we're trying to be more defensive. So we add value that way. But also within the securities we select within the portfolio, within the government universe, there's a lot of opportunity to add value. And this is where my experience in government and my experience in markets really kicks in, because you need to get down into the weeds of what's going on. You need to be able to work out which states are going to perform and which states aren't. These are the sort of things that people often gloss over and they really don't dive into. It's my specialty, and it's a way we use heavily to add a lot of value to a government bond portfolio. So we are working hard all the time, both to get the macroeconomics right, whether interest rates are coming up or down, whether inflation's coming up or down. We do a lot of research into that. But secondly, we do a lot of active management around which securities we put into the portfolio.